Hello and welcome to the June 5th edition of the Gold, Goats, and Guns Market Report. My name is Tom Luongo. Happy Ubik Day, everybody. And for those of you who don't know what I'm talking about, this is the day of the year in which Philip K. Dick's seminal novel Ubik opens on June 5th, 1992. And it's a book that I read every year. It's my favorite book of all time. And it's a book that I read every year on June 5th in appreciation of it for years. I must have read Ubik 15 times at this point. Haven't read it in a few years because, well, you know, it's just one of those things. But it's an absolute seminal work of modern speculative fiction. If you haven't read it, I highly recommend it. It is one of the funniest and most devastating pieces of work ever. 175 pages. It's absolutely brilliant. All right. That being said, let's move on to the surreality of today. Now, I just want to clarify the title or the caption for our today's picture. That's the impotence of the British left, not Donald Trump. Just want to clarify, but because given the way that I have actually ripped on Trump recently, that could easily be taken the opposite way. But this is what I meant. That's what I meant. That's what I intended. Whether you want to take it as a double entendre or not is perfectly up to you. All right, so let's talk about Trump's state visit in the UK. I find it mostly sideshow theater. My wife this morning was listening to Mandy Bombard's take on the Bombard's body language, her take on the Trump-Theresa May press conference. It's very obvious that Theresa May is a Remainer. She's obviously a consummate liar and a globalist and all of that stuff. And Trump saw right through it and damned her with faint praise. It was kind of awesome in his own way. Again, you know, Trump is driving me absolutely insane, but when he's trolling people, he's still a lot of fun. So that's pretty much all I can hope for at this point, because he's complete ignoramus on everything else. So that's where we are. So don't read too much into the insane bleeding of the globalist left over in the UK. It's mostly an expression of people whistling past their own graveyards as Brexit takes center stage and destroys what's left of their political influence over time, because that's what's coming, and everybody knows it. So I don't really have much more to say about it than that, but it is dominating the headlines. It's like everybody is the British tabloid media is doing everything it can to blow out of proportion every little thing. You know, the way I was talking with Jeff Rentz about this last night. The way the Queen was moving her handbag around, or you know, the way Trump shook her hand, or all this the crazy stuff. And it really comes down to, at the end of the day, that there's globalists in the British deep state. There's globalists in the media. They're all part of the game, and they don't like Trump because Trump is allied with Nigel Farage to break that all down. In his own way, that is, and in some ways, Trump will support that process, and in other ways, Trump will not support that process. What Trump wants is a return to the post-World War II political order minus the globalists. That's what he wants. That's his version of a great America, right? When you really stop to think about it, and it's finally just kind of came into my head as I was saying it, oh, really, all Trump wants when he says make America great again, he wants the fictional America that didn't have globalists and didn't have a deep state, that existed after World War II, that rebuilt the world and was a shining beacon on the hill to everybody else. That's that version of the United States that he was sold as a boy. It's not real. It never was real. And he's not going to create that the way he's going. That, you know, he's not going to create that. He's just not. Because he's not. All right. On the other side, while this is going on, Putin and Xi Jinping of China are meeting at the St. Petersburg International Economic Forum, or SPIEF, in which hundreds of billions of dollars of deals will be made. And the Russians and the Chinese will most likely issue an MOU deepening their strategic economic and political, and military coordination efforts. I expect that over the course. I expect nothing less than that. And how they're going to approach the further integration of the Russian and Chinese economies to support Belt and Road, and to support the expansion of the Russian industrial base, which is also coming. This is the part that people don't quite realize is going to happen here, is that the Russians are going to turn into a manufacturing powerhouse over time, because wages there are still terribly depressed. But they have an infrastructure that is more than possible to create an intellectual base and a research base that's more than capable of building a better Russia from within over the course of the next generation. And we're going to see that unwinding of a number of things that are still holding the Russian economy back, not the least of which is the globalists within the financial system and within the Bank of Russia. But I think it's deeper. I think it's more than that. There's just little things that need to go away. Russia's VAT is way too high. It's at 27%. Their sales tax is insane. Their taxes, their income taxes are low. Their corporate taxes are incredibly low. The Russian corporate tax is 9%. But they have an incredibly high value-added tax. And I think that's part of that. That's also part of their problem. But again, there's plenty of room for them to lower interest rates and to spur a manufacturing and a foreign investment boom that ensures that the money stays in Russia at this point. And the more that money goes into Russia, it's not going to be able to come right back out in the form of dollars, because they're removing dollars. One of the benefits of removing dollars from the Russian economy, which is still a process here, is that once the money goes into Russia in the form of once dollars and euros go in, you can convert to the rubles. It's going to be very hard to convert them back out again, because of the way the Orange Obama and Mr. Tariff Man is operating. Well, we're not allowed to transact in dollars. Well, okay, fine, we won't. We'll transact in other things. So the meeting between Putin and Xi is going to be very important. It's going to coordinate policy for when Putin meets with Trump and Xi meets with Trump on the sidelines of the G20 in a couple of weeks. And we'll see how that plays itself out. But don't expect anything headline-shaking coming out of St. Petersburg. It will just be more of the same, and it will be more of the. It'll be more in the right direction. We had some very good news on Gazprom. I don't have a chart for you today, but this ties into what I'm talking about, and that that Gazprom has jumped dramatically in the last couple of weeks over the expansion of the dividend, but also the potential threat of them overhauling the management structure of the company and making it much more like a normal company and much less like a monolithic state-owned enterprise. That's going to come sooner or later. Gazprom is eventually going to lose its monopoly over gas transit across its pipelines. That's going to go away. And there's a number of other things that are going to go away as well. But it's just a harbinger of where Russia is moving here. And as we move into a period of fiscal and political insanity, Russia is going to look like a very good destination for marginal safe haven capital flows. We're already seeing it, but we'll see more of it. And as they make smart moves in liberalizing the internal economy, the way capital is handled internally, the way stocks are traded, and the rest of it, as those things improve and rise to Western standards for liquidity purposes, the more that happens, the more Russia will become a destination of capital, and that capital is not going to want to leave, because why would you want to leave a country where the government treats your capital well as opposed to treating your capital poorly? So, all right. So there's that. And this is the other part of the reason why Trump is sanctioning everybody imaginable. He's trying to keep money from flowing into these places and hoard it all, and hoard the liquidity in the dollar. And he's going to find that you can't abuse your customers for very long without them just saying, no, dude, it doesn't work. You can't raise, the higher you raise the cost of doing business in dollars, the easier it gets for me to do business in some other crappy currency. I have a chart today on retail, because I know that I wanted to follow up a little bit on what I talked about in real estate the other day, because what I did in real estate was just a very small thing. So I thought about it this morning when I was putting my slides together, and I wanted to put something together that falls into this, because I listened to a very good interview with Brian Reynolds that was given to me that was passed on to me by a subscriber, and I appreciate that. And I listened to it yesterday; it was very good, and I should put a link to in the description to this video, because I think it's very, very strong. This is good information both for retail investors and professionals. I think is very strong, and talking about how the commercial real estate market is being held up in many ways still by pension funds looking for yield in commercial real estate junk bonds. I think it's a very strong. I think it's a very strong argument that Reynolds makes in the interview, and one I found interesting and enlightening. So I'm going to talk about retail a little bit. I'm going to show you a chart of one of the ETFs in just a minute, just to give you a flavor as to what I'm talking about in relation to what we saw in REITs the other day. And then, of course, can't get anywhere without talking about the rally in gold. And gold is up again this morning, knocking on 1350. Hit a high of, I think, 1347 to 1348. It's attenuated a little bit as I do this. Is about 10:30 in the morning, or 10:15 in the morning. I just got done with doing 40 minutes with Garland. Otherwise, if I wasn't on fault lines this morning, this would have been out earlier. I did all the slides beforehand, but I ran out of time to cut this before I could. I had to do the interview because, of course, goats have to be milked. So, and they didn't get up at 4. All right, so that's pretty much what I've got in terms of opening remarks. Let's get to the charts, and I'll get you out of here. All right, so sometimes a chart speaks for itself, and you don't really need to say very much. This is all you need to really care about. That's the important point here. It doesn't and by the way, we don't have to reach that this week. We don't reach that today or tomorrow or Friday. We got all next week to get up there. But this push towards it today is really good. Actually, a small pullback, and holding in the 1330s and maybe building a little bit of a flag pattern or a little bit of an eighth note pattern, that'd be great, because then that's going to build a base to go attack 1375 and possibly higher. And, I'm being very cautious in the way I analyze these breakouts. I was cautious in my breakout, in my analysis of the breakout of Bitcoin. I'm going to be cautious in my analysis of the breakout of gold, because you should be. Because they're still technically in bear markets. And so bull markets climb a wall of worry. I should remain skeptical until we get the actual signal. And when we get the big signal that gold is ready, I'm going to get the right 6,000 words in a newsletter about how here it is, we're good. I mean, and you guys will know what the newsletter is going to be about that month if you see gold put in a weekly close above 1375. I got news for you. It won't be hard for me to write, and it'll probably take me about 20 minutes to write all 6,000 words. And be like, this is great. I'll just be in like hog heaven, for Christ's sake, because I've been waiting for it for 8 years. And when you finally get a chance to write that, I've been waiting to write waiting to write that newsletter for 5 years now, 6 years now. So we'll enjoy that one. I really will. We're very close. The way this market is acting right now is different in a very fundamental way than what we've seen previously. And I think Zero Hedge had a note about the types of inflows into gold that are at 6-year high. I don't remember what it was, but it was. I don't remember the article. I read so much anymore that I can't. It all kind of blurs together. But that they noted there's a very anomalous behavior that's happening in the gold market right now, and that means that sentiment has shifted dramatically, and that means I'm just not really that worried that we're not going to see an attack on 1375, and that we may even break through it this time. Still being very cautious on this. I still think there's probably one more bounce off of it's going to hit 1375 and then be sold with impunity, and then the reaction to that's going to tell you everything. If the reaction down from the attack on 13, well, first this one at 1350 and then 1375. If this one is not met with an immediate like $35 drop, then and is allowed and the market pushes through 1350 to 1375, I think that those reactions are far more important at this point than the moves up. The moves up get everybody excited. It's how the market corrects that tells you everything that you need to know about what's going to happen next. It's kind of like what I was saying when we hit 1260 here, and I said, okay, so, this is not good. We broke this low, we broke that low, we broke that low. There's no real support on the chart, but, here we go. We got down to 1260, and somehow the market just said, okay, that's enough. And then we got this bullish engulfing bar, which was itself also a reversal bar. And that stabilized the market. That was everything we needed to know. And then boom, 5 weeks later, we're off to the races. So again, the signals are there if you're willing to look for them. And if you strip, and I just believe, I really do fundamentally believe that if you strip as much information off your charts as possible and you just look at the candles will tell you 90% of what you need to know. All the other stuff is just there to cloud your analysis. The RSIs and the stochastics and the energy models and the trend and the channels and the this and the that. I look at that stuff and I go, it's nice, but all it does is then makes you keeps you from just seeing clearly what's in front of you and what the market is telling you. The market's already telling you everything you need to know by the relationship between open, high, low, and close. And everything else is just kind of noise. And I know that's anathema to a lot of people, and I know that may even sound condescending to those of you who have your own trading systems and whatnot. This is just the way I've seen it after I've been looking at markets since I'm 28 years old. I'm a really smart guy. I've tried everything under the sun. I've tried trading under every, and none of it works. This shit works. It just does, because open, high, low, close is truly all we know. Everything else is a derivative. And even these probability models are all based on a normal distribution of, and all based on things like normal distributions and all those basic statistical assumptions that we take for granted, but are mostly wrong, right? And so I know that there's golden relationship. I know there's Fibonacci. I know there's all that stuff. And every once in a while, when you're in a broken field territory like we're getting into with gold, at a certain level, look, this chart right now, there's nothing that the candles can tell you other than to watch them individually and see how they play out, because we're now broken field, what I like to call broken field running. It's just, the market's just moving now. But I don't know. And then, maybe things like Fibonacci, or, you can also look at volume by price, right? And all those kinds of charts. And I like volume by price as well. That also tells you where there's gaps and there's pits. There's gaps above you, and there's air above you, and there's gaps below you, and there's pits below you. I do like volume by price overlays. I don't do it here because I build these charts in Excel, right? And these are Excel spreadsheets that I build for this. So I don't build a volume. It's not possible to put volume by price on here as well. I wish there was. I wish Excel would give me that opportunity, because then I would use it, right? But I can't. So I really like what I'm seeing in gold, but like everything else, buyer beware. So 1350, then 1375. All right, Bitcoin. So you'll notice I finally took the big old, what I looked at, the Fibonacci time series. I took that off of here because we got our correction. Now, we may not even get a close this week below this low, so this might even wind up being a reversal bar. That would be really interesting if it did that. If we got a correction and a non-reversal bar this week, then 12,000 is pretty much probably in the cards at this point, guys. Because there was a massive liquidation. There was a massive correction. The dollar is getting sold. There's a number of things happening here. We saw a big move into safe haven assets, including the Dow, by the way, off the low from the other day. Not surprised that after a huge run up like this, that finally Bitcoin wanted to correct $1,500. I think that was perfectly reasonable. And even any move back to the 6,500 area down in here, I think it would be fine. If there's a correction in Bitcoin down between 6,500 and 7,000, that would be perfectly reasonable for this run, and then bounce off of that and go higher. That would be fine. We have to alleviate, at some point, you have to alleviate the buying energy, and you have to reset the market, and you have to allow people to get short, and you have to build that short interest, and you have to build that bearishness in order to get more bullishness. It's just the way it is. So, and every market's that way. It doesn't matter what it is. It doesn't matter if it's Bitcoin or soybeans or, I don't know, stocks, whatever. It doesn't matter. All markets have to do that. You have to get imbalance on one side in order to get a reaction in the other direction. So Bitcoin was, obviously getting irrationally bullish. or irrationally exuberant, to quote Alan Greenspan. Now it's time to pull back, reset everybody's expectations, let everybody remind themselves of how dangerous this market is, and then we move on. All right, so not a lot to say about Bitcoin this week either. So this is the Spider S&P retail ETF. God, I had the ticker symbol on my lips and now it's gone. Can't remember, but you can look this one up. So this is just retail stock ETF. It's very, very balanced in terms of its portfolio. I went and looked at its holdings. Nothing is over 2%. Amazon is represented at 1.33%. It's actually not even a major, not even the biggest holding in this ETF, FYI. So, and I did that to make sure that we weren't, that I wanted to see if, the valuation on this included some of the big online retailers. So this is a 5-year chart of this ETF, and you'll notice that it's gone nowhere over the course of this whole Trump expansion. Oh yeah, it moved from 37.50 to 50, okay, and then it immediately collapsed. And it collapsed when? Right about the time that Jeff Snyder would call Eurodollar 4 happened, right around when Trump started putting tariffs on everything. When Trump put tariffs on aluminum, when the Eurodollar markets broke, and now all of a sudden, commercial retail stocks are in trouble. This is going to bode poorly for commercial real estate, okay? And that's where I think, and this is part of the Brian Reynolds interview from yesterday, or the other day that I listened to yesterday, and that where there's going to be a lot of leverage buyouts in this space. There's going to be a lot of consolidation in this space, and as retail comes under even greater pressure. If this were to break down, obviously there's support at 37.50 on this ETF. This is only, by the way, at these prices, is only trading with a 1.5% yield. This is not an expensive stock. This is not a cheap stock. At 1.5% yield, this is not a cheap stock. And that's why some of these months are incredibly bad. Okay, so I caution you, if this was trading at 3.5%, I'd be like, oh, no, it's trading at 1.5%. That's not a good yield. Not at all, right? And that's why it couldn't break above 50, and it's not going to. So I didn't check the aggregate earnings, I didn't check the aggregate PDE on this. I didn't check Morningstar this morning. I only just did a cursory glance at investing.com. But I would say that, watch the retail space carefully. We're going to see more and more bankruptcies. The malls are not coming back. They're all going to get turned into ice rinks or some other damn thing. Or, I don't know, go-kart tracks or whatever. But they're not going to be turned back into commercial real estate of that kind anymore. That era of shopping here in the United States is over. It's just over. It's done. And it's not coming back. And, there's been a big move into commercial real estate on the part of the pensions looking for yield. And that's probably the next bubble to burst. Now, when that's going to burst, I don't know. But it's definitely we can watch the retail stocks to get an idea of what's going to come forward. So if this ETF and others like it are trading down at the bottom of their 5-year trading range at the end of a massive shallow expansion at 1.5% yield, what's the downside target on this ETF? I'd say 25. And then what does that do to the commercial real estate space? How many store closings are we going to see? How many this? I mean, it's all that stuff. Okay, and that's going to filter its way into everything. And the credit markets, and that's the mechanism by which the credit markets here in the United States are going to seize up. Okay, but in the short term, safe haven capital flows could easily see people piling in out of Europe and other places into terrible junk bonds. Commercial junk bonds on this kind of property, speculative bets on this kind of property, structured in such a way to generate the yield necessary to make them attractive to pension funds desperate for 7.5% yield. Okay, just another wrinkle on the whole. The pension funds are going to kill the United States thing. All right, and the last thing to talk about today is the Dow, because we talk about the Dow all the time. The breakdown last week was bad. We've got a dead cat bounce this week. Closing above this week above the breakdown level would be good, but this is your next area of resistance, area of support, sorry. And it's not really this line, it's this whole area. You've got a number of lows in here between 24,000 and 24,200. That's what I would consider your support range. This would have been better to have put up as a box or shaded area as opposed to a discrete level. Okay, so I think that that's needed. And this is a good, solid downtrend and a good, again, resetting of expectations on the Dow before things move higher. We could, if we don't reach this, that'll be strong. And then again, when markets bust, how they bust is as important as what they do after. Is what they've done before that. So, I don't know what to tell you at this point about the Dow. The Dow looks very neutral to me in this trading zone here. And this is your bottom end. If it drops below that, then we're going down to 21 grand. But if it doesn't, and if it doesn't even reach this level, then we're easily going to go back to 27. Especially because the market's not convinced at this point that the Fed's not going to lower interest rates. And if the Fed lowers interest rates, I got news for you. Oh, the Dow is going to go ballistic. So is gold. So is everything else. All right, that's what I've got for you today. I hope that this was instructive, and I hope that it was entertaining, and all of it. So I'm going to get going. I got to go finish the newsletter. I got to write my editorial today, and I still don't quite know what it's going to be about. So I'm going to go have a cup of coffee and walk around my yard, look at my goats, think about that for a minute, and then I'm going to get right on it. So you guys have a great afternoon. You take care. You be well. We'll talk Sunday. Keep your stick on the ice.